Welcome back to another episode. In today's program, we're going to talk about 2025 IRA, 401k, and other plan contribution limits. What better time than now in January to start planning ahead? How can you maximize contributions to your IRA, to your 401k, maybe a SEP, simple IRA, and even maybe a health savings account? A lot of people aren't aware of the fact that they can self-direct an HSA. So let's go ahead and get started with IRAs specifically. So the contribution limits for 2025 to IRAs, no changes from 2024 to 2025. When you're under the age of 50, you can contribute $7,000 to either a traditional or Roth IRA, or combine between both the traditional and Roth. The maximum is $7,000 when under the age of 50. When you're 50 and over, there's a $1,000 catch-up contribution. That gets you to a total of $8,000. Now, a common question I get is, can I contribute to a traditional IRA, let's say $7,000, and then separately a Roth IRA $7,000? The answer is no. So you got to choose from one of the two or combine between the two. Again, you have $7,000 when under the age of 50, $8,000 when 50 and over. Another common question I get is, what if I have a spouse that's not working? Now, let's assume that you're married filing a joint return. You have a spouse that doesn't have earned income. Well, that's okay. Your earned income can support your spouse's contribution. This is referred to as a spousal IRA contribution. You can go to IRS Publication 590 to learn more about this. Now, lastly, you have to be aware of the fact that if your earnings are too high, if your modified adjusted gross income, MAGI, is too high, you are not allowed to contribute to a Roth IRA. And you're going to want to go directly to the IRS website, irs.gov, to see what these limits are, or talk to your tax professional or CPA about the matter. If you're over the MAGI amount, you might want to speak to your CPA or tax professional about what's called a backdoor Roth contribution. Now, that's not a legal term, it's an industry term. So what we're talking about is, if you make too much money, you can consider contributing to a traditional IRA and then immediately converting over to a Roth IRA. Again, this is referred to as a backdoor Roth contribution. All right, now on to the 401k. And keep in mind that if you're eligible, you meet all the requirements, you can contribute, max out your IRA, and then separate max out your 401k. In my experience in doing this nearly 20 years, so many people are led to believe that they have to choose from one or the other. If they're contributing to their 401k, they're not allowed to contribute to an IRA, or vice versa. That's absolutely so far from the truth. Why not, if you have the capability, contribute to the IRA and contribute to the 401k? Remember, compounding interest in the absence of taxation. So let's dive in here. With the 401k, you're going to learn about in a moment this concept, or this way in which you could potentially, between a certain age, contribute a lot more money on an annual basis. This is what we call super funding. Okay, so a 401k, you can contribute when you're under the age of 50 for 2025 up to $23,500. That amount went up by about $500. So last year it was $23,000. This year it's $23,500. Now, if you are 50 and over, there is a catch-up contribution, which far exceeds the catch-up contribution of an IRA. Remember, an IRA catch-up is $1,000, but a 401k is much greater. In fact, it's $7,500. So the total amount that you can contribute when you're of the age of 50 or older to a 401k is $31,000. Now, some of you are working a W-2 job, you have a 401k, that's the amount you can contribute. Others, maybe you're a self-employed individual, so you want to look at a self-directed solo 401k that's going to carry these same contribution limits that I'm talking about. Okay, so again, in recap, as an employee contribution to a 401k, you got $23,500 when you're under the age of 50, $31,000 when you're 50 and over, because that includes the $7,500 catch-up contribution. Now, it doesn't stop there, because there's what's called an employer contribution, or if you're working for a company, might be referred to as an employer match, or sometimes a profit-sharing contribution. When you combine the employee contribution and the employer match or employer contribution, the total amount that you can contribute in 2025 is $70,000 when you're under the age of 50. And then when you're 50 and over, it's $77,500. You'll also learn that with most 401ks, and certainly with the self-directed 401k through Equity Trust, you have the ability to make your employee contribution as an after-tax or Roth contribution. So that money goes in after tax, no deduction, but then it grows tax-free, just like a Roth IRA. And then the employer contribution, that must go into the pre-tax bucket first, but then you can utilize a technique called a in-plan conversion, where you can actually convert that over to the Roth, pay the taxes. It's not double taxation, but pay the taxes. And your net effect, if you have enough earned income, you could potentially have $70,000 in the Roth component of that 401k when you're under the age of 50. And when you're 50 and over, that could be up to $77,500. So imagine that, having $70,000 or $77,500 that's growing tax-free through the various investment strategies that you're deploying, and you'll never pay a dime of tax ever again. Again, that's what we call compounding interest in the absence of taxation. Now, what happens when you get to the age of 60 to 63? Well, see, in December of 2022, the Secure Act 2.0 was passed. And within this legislation, they made a slight adjustment to the catch-up contribution for individuals between the age of 60 to 63. See, in 2025, if you're between 60 to 63, with a 401k, your catch-up contribution is not $7,500. You can actually contribute up to $11,250. And each year going forward, assuming that there continues to be inflation and they continue to look at the cost of living adjustments, they'll increase those amounts year over year. Now remember, IRA contributions do not change year over year, so that doesn't mean that the catch-up contribution will change next year. But for 2025, remember, it's $11,250. So when we talk about super funding or super catch-up contributions, that's what we're talking about there. Now that's 401k. Are there other business retirement plans that one can consider beyond a 401k? Well, there certainly are. For self-employed individuals, oftentimes you'll hear people will look to open a SEP IRA. With a SEP IRA in 2025, you can contribute up to $70,000, not to exceed 25% of your W-2 income if you're structured that way, or 20% of your self-employment income. And then with a simple IRA, as an employee, you can contribute up to $16,500 when you're under the age of 50. There's then a $3,500 catch-up contribution for those that are 50 and over. And a simple IRA, just like a 401k, actually has that same provision that we talked about with the 401k, where between 60 to 63, you can make an additional catch-up contribution that goes beyond the $3,500. It's actually $5,250. So we talked about the IRAs, we talked about the 401ks, SEP Simple IRA, and then I would encourage you, for those of you that qualify for an HSA, so if you have a high deductible healthcare plan and you have an HSA health savings account, you might want to look at and go to the IRS website, irs.gov, to look at what the contribution limits are for an HSA. Keep in mind, your HSA contributions are tax deductible, it grows tax-free, and when you take the funds out and pay for medical-related expenses, whether that's now or you're reimbursing yourself for a past year medical expense, it's tax-free. So we find a lot of investors here at Equity Trust are self-directing all of these accounts, IRAs, 401ks, HSAs, Roth IRAs, SEP IRAs, Simple IRAs, from a self-directed alternative investment perspective. All of the accounts operate virtually the same. All right, now before we go, very important that I mention this last point. If you didn't max out your contribution in 2024 and you're eligible to do so, you still have an opportunity to make your 2024 contribution. See, the IRS allows you to make your IRA contribution even into the following year, as long as you get it done before the tax filing deadline. Now, that does not include extensions, so you got to make sure that you get it done before the tax filing deadline, which is generally April 15th. So again, for those of you that didn't max out your contribution in 2024, you have in between January 1 and tax filing deadline to make your 2024 IRA contribution. I hope you enjoyed today's program on 401k contributions, the catch-up contribution when you're 60 to 63, SEP IRA, Simple IRA, and then don't forget about the health savings account. Until the next program, keep leveraging compounding interest in the absence of taxation. Thanks for watching. If you enjoyed this video, don't forget to hit the subscribe button right here so you never miss out on new content. And if you're ready to dive deeper, check out our other videos and resources right here.